Welcome back to Investing Talk Podcast. Today we are focusing our exploration on Energy Fuels, a company quite uniquely positioned, really. They're in both the uranium energy sector and this burgeoning critical minerals space. And the crucial question you posed, the one we're digging into today by looking at the latest financials and news, is pretty straightforward. Is Energy Fuels a good time to buy right now?
Before we jump in, just a quick reminder, please subscribe, like, and comment on this analysis. It really helps us out. Oh, and if there's a specific company you want us to investigate, please do leave a comment below. We'll add it to our list.
Yeah, this company is, it's a really fascinating case study. You've got this blend of, what some see as traditional energy nuclear fuel, but it's meshed with these high-tech inputs needed for, well, next-gen clean energy and even defense tech. And we've got a pretty solid stack of recent news financial analysis, too, to help us really tackle that question for you. Okay, let's get started then. We need to unpack what's been driving this incredible momentum just over the past quarter, and maybe more importantly, what catalysts are potentially waiting just around the corner. I mean, the stock has been on a serious run, up, 42.5% in just the past 4 weeks alone? That's huge. So looking back, maybe over the last 3 months, what specific things really drove that massive surge? What got investors so excited?
Well, what's really fascinating here, I think, is that the momentum isn't just from one single thing. It's the synergy. It's how their two main business lines, uranium and rare earth elements, REEs, are working together. They hit some really significant tangible milestones on both fronts almost simultaneously. It sort of proved out both their legacy business and their future strategy at the same time.
Okay, let's break that down. Starting with the uranium side, what was the big news there?
The main highlight was definitely the record-breaking performance they reported back in Q2 2025. Specifically, their Pinyon Plain uranium mine down in Arizona really exceeded expectations. They pulled out 638,700 pounds of uranium. And importantly, this wasn't just high volume. It was driven by really exceptional ore grades. And that translates directly into lower operating costs, So that pretty much cemented its status as, well, one of the most promising new domestic uranium mines out there.
Right. So low-cost production hitting the market, just as nuclear energy seems to be having this global comeback moment. That's a solid driver for the stock price, for sure. But you said that's only half the story.
Exactly, because they coupled that uranium success with a really major breakthrough on the rare earth side. And this is what validates their longer-term pivot, their strategic shift. In August 2025, they announced they'd successfully completed their first kilogram of high-value dysprosium oxide.
Okay, dysprosium oxide.
Yes, go oxide.
For those of us maybe not up on our periodic table, why is that specific one such a big deal?
Good question. It's crucial because it's a heavy rare earth element. These HREs, they're much scarcer. Chemically, they're a lot harder to separate, but they're absolutely vital for things like high-performance magnets, think defense applications, high-end EVs, that sort of thing. So producing that first kilogram, especially after they'd done pilot-scale production at their White Mesa mill back in July, that's a massive technical hurdle cleared. It signals that their path towards commercially viable, high-margin, heavy, critical mineral production. It's real.
Got it. So they're proving volume in uranium, and they're demonstrating the potential for high margins in rare earths. Now, growth like this costs money. Let's talk financing. How did they manage to secure the capital they needed without, completely wrecking the balance sheet or diluting shareholders into oblivion?
Right, and that's where some pretty sophisticated financial footwork comes in. In September 2025, they closed an upsized $700 million convertible senior note offering. So that gave them the long-term capital needed for project development, building out this REE capacity. But here's the really smart part. They used something called capped call options alongside it.
Hold on, capped call options. That sounds like serious finance jargon. Can you break that down for us? How does that actually protect shareholders from dilution? Isn't it just more debt?
That's the key distinction. Yeah, it's clever. When they issued those convertible notes, meaning the debt could convert into stock later, they simultaneously bought these capped calls. Think of it like buying an insurance policy against your own stock price going too high, strange as that sounds. It sets a ceiling, a cap, on the stock price at which those notes would convert into equity. So if the stock price absolutely explodes upwards, which is what everyone hopes for, right? The capped call partially or even fully offsets the potential dilution from the notes converting. It protects the value for existing shareholders.
Okay. That reframes it completely. It's not just taking on debt, it's doing it in a way that hedges against the dilution risk if they're successful. So let me recap. Producing record low-cost uranium, validating their pivot into these high-value rare earth oxides, and shoring up the balance sheet with smart financing.
Okay, yeah, that combination definitely explains the recent surge.
Exactly. And if we connect this to the bigger picture, we kind of move from the recent headlines to the core strength, right? The fundamentals and their unique competitive edge, their moat, basically, because that's what determines if this run is sustainable.
Right, the fundamentals. So looking at the books, the TTM that's trailing 12 months revenue looks strong. It's $65.08 million, dollars, way up from about $12.5 million back in fiscal 2022. But here's something interesting. Consensus forecasts actually predict a slight decline for the full fiscal year 2025 revenue, down to maybe $58.90 million. Given all the positive stuff we just talked about, why would revenue dip short term? Yeah, that's a critical point, and it really gets to the heart of understanding the long-term story here. It's about timing. That anticipated short-term dip, it likely isn't a sign of failure. It's probably more reflective of a necessary strategic investment phase, a ramp-up phase. Remember, they're transitioning from being mostly a uranium miner to also being a highly complex chemical processor for these rare earths. Scaling that separation technology, it takes time, it takes capital. You might have to pause some older processes to focus on commissioning the new stuff.
Okay, so the market might see that slight revenue dip in 25, not as a problem, but as them actually investing heavily in the infrastructure for that next big growth phase.
Precisely. The market seems to be looking past that dip, focusing entirely on the payoff. Analysts are expecting a really sharp rebound in fiscal year 2026 revenue. They're forecasting it to jump to a massive $145.27 million. I mean, that's a projected growth of almost 147% year over year. Huge.
Wow, 147% growth. That's explosive, almost unbelievable, really. What specific things have to happen operationally for them to actually hit that kind of aggressive forecast? That feels like where the real execution risk lies.
Absolutely. That's the key question. That 147% jump relies on a few big things happening. First, achieving full commercial throughput at the White Mesa Mill for the rare earth processing, really getting it humming. Second, maintaining stable, high-volume, low-cost uranium production, likely from mines like Pinyon Plain, to meet what they hope are increasing demand contracts. But honestly, if they hit commercial scale on the REE separation side, the margins associated with those high-purity oxides, that's what will power that revenue jump much more significantly than just uranium volume alone.
Okay, revenue's one thing. What about actually making money? The bottom line. TTM net income is still showing a loss, right? Around $93 million. What's the outlook for profitability?
Right, they're still investing heavily. But the analyst consensus does anticipate EPS earnings per share returning to positive territory. They're forecasting around $0.05 per share by fiscal year 2026. So that signals the expectation that the massive operational leverage from this new RE business should finally kick in, driving margin recovery after all these years of heavy investment.
Okay, so the financials point towards future growth, albeit with that execution risk. But beyond the projections, what makes Energy Fuels defensible? What's their operational moat? What stops competitors from just doing the same thing?
That's a great point. Their competitive advantage, their moat, is actually pretty significant, especially in the U.S. context. It creates really high barriers to entry. First off, they operate the only fully permitted and operating conventional uranium mill in the entire United States, the White Mesa Mill in Utah. That existing infrastructure, already permitted, already proven, that's invaluable. You basically couldn't replicate that easily today, given the regulatory environment.
Yeah, getting anything like that permitted now would be incredibly difficult and time-consuming. Okay, so that's a big piece of infrastructure. What about on the rare earth side?
Second, they are the first U.S. commercial producer of high-purity NdPr oxide. NdPr, that's neodymium and praseodymium. Those are the absolute workhorses for permanent magnets. They're in almost every EV motor, every wind turbine generator. Producing that specific oxide at high purity domestically, that's a huge strategic achievement right there.
Yeah.
And third, and this might be their most unique and defensible position long term, is their focus on scaling the separation of the heavy rare earths. Things like the dysprosium we mentioned and terbium too. They are positioning themselves as really an emerging leader in this very niche, highly strategic area of critical minerals. And this is happening precisely when the global supply chain is actively trying, to pivot away from such heavy dependence on China for these materials. They're essentially solving a potential national security problem.
Yeah, that makes a lot of sense. They have the assets, the forecasts look aggressive. This is where it gets really interesting for investors looking at the near term. What specific measurable events should people be watching over the next, say, 90 days? What are the immediate potential volatility points for the stock?
Yeah, The next quarter looks extremely catalyst-rich, lots to watch. The first major event is definitely their Q3 earnings release. That's scheduled for October 30th, 2025. Now, the forecasts are pointing to around $9.85 million in revenue. That would be a huge jump, like 143% year over year. But remember, it's compared to a very low base last year. They also expect a further narrowing net loss, maybe around 0.088 per share. But what the market will really be watching closely are two key metrics within that report. First, confirmation of continued high uranium production volume from Pinyon Plain. Is that sustainable? And second, and this is crucial, the absolute first glimpse of preliminary revenue, even if it's small, from those new rare earth oxide shipments. That validates the commercial path they're on.
Got it. Earnings on October 30th. Key numbers to watch. Are there any broader market forces, things outside their direct control, that could impact the stock in the next few months?
Oh, absolutely. You've got scheduled market events. For example, ETF rebalancing for both the uranium ETFs and the rare earth element ETFs. That's typically scheduled around November 30th. Now, if there are significant shifts in market flows, say, if big institutional money decides to pile more heavily into nuclear and REE stocks heading into the year end, that could provide a real liquidity boost and price support, kind of independent of specific company news.
Okay, ETF flows. Interesting. Now let's get into the more speculative side, the higher risk, higher reward stuff. What potential news out there could really move the needle overnight for energy fuels?
Right. This is what keeps traders on the edge of their seats. There are three key speculative catalysts investors are watching very closely. One is the possibility of significant non-dilutive government funding. We're talking about potential direct grants or maybe major long-term contract awards from the U.S. Department of Energy, specifically aimed at reestablishing domestic nuclear fuel supplies. That would be huge, stable, high-margin contracted revenue. Number two, there's quite a bit of market chatter, rumors really, around potential strategic partnerships. Think joint ventures or maybe long-term supply deals with major battery manufacturers or EV companies. I mean, these companies are desperate to secure reliable, non-Chinese sources of critical minerals like NdPr and the heavies to future-proof their own supply chains. A big deal there would be massive validation. And finally, there's the ever-present geopolitical factor, specifically expanded Chinese export controls on rare earths. China has tightened things before. If they were to broaden those restrictions further, well, suddenly energy fuels domestic production capacity, especially for those heavy rare earth oxides, becomes exponentially more valuable. It could significantly boost their potential market share and definitely their pricing power almost overnight.
Wow. Okay, so that's a potent mix, verifiable near-term growth tied to earnings, plus these potentially explosive policy or partnership catalysts. Shifting gears slightly, what about the technical picture? Does the stock chart actually support this fundamentally bullish outlook, or does it look like the stock might be getting ahead of itself, maybe overextended?
That's always a fair question after a big run-up. But currently, the technical picture actually seems to reinforce the fundamental story. It suggests a bullish trend continuation is more likely than not. The stock closed recently around $19.70. And critically, it has been trading consistently above both its 50-day and its 200-day moving averages. That's generally seen as confirmation of strong institutional support and an uptrend. The key resistance level everyone's watching right now is $22. That was the recent 52-week high. If it can break decisively above that psychological barrier, that would likely signal a definitive new leg up for the stock. And you see this reflected in the broader analyst sentiment too. It's firmly bullish right now. For instance, B. Riley, a well-respected firm, recently raised their price target quite significantly from $11 all the way up to $22, and that echoes the strong buy ratings you see from a majority of the analysts covering the stock.
A strong buy consensus is certainly hard to ignore. But, no investment is ever risk-free. We touched on execution risk earlier. For our listener considering this company, what are the key downside risks they absolutely need to be aware of? We need that balance.
We absolutely do. While the upside potential looks compelling, the risk profile here is definitely high. You have to be clear-eyed about that. I'd put the risks into two main categories. First, yes, that execution risk we flagged earlier. Scaling up these new, very complex, rare earth separation processes is technically demanding stuff. Any significant delays, unexpected cost overruns, or maybe failures to consistently meet the required purity standards for these oxides, any of that could severely impact the timeline for achieving profitability. It could push that massive 2026 revenue forecast back, maybe by a year or more.
And a delay like that, given how much future growth seems priced in, would likely punish the stock pretty hard, wouldn't it?
Oh, instantly, yeah. Second, and this is critical, there's significant commodity volatility. Despite their strategic transition into value-added processing, the company's revenue, at its core, remains fundamentally subject to the whims of uranium and rare earth prices. These are highly cyclical industrial commodities. A major global economic downturn or maybe a sudden surge in global supply from somewhere else could easily offset all their operational improvements. It could hit their margins hard, even if they meet their production targets.
Okay, so execution risk on the tech scale-up and commodity price risk. Got it.
Mhm.
So bringing it all together, the record output, the smart funding, these unique competitive advantages, especially in the high-value critical minerals, plus this packed upcoming catalyst schedule. What's the final investment thesis presented in the source material we looked at? And considering those risks you just laid out, can we genuinely stand behind that consensus view?
Well, the source material we analyzed assigns an overall bullish rating of 9 out of 10. And yes, I think the rationale holds up, largely because you have to weigh those risks against the sheer strategic necessity of what they're producing. The core thesis is pretty clear. You've got strong technical momentum supporting potential short-term gains, maybe around those Q3 earnings or policy news. But more importantly, you have these powerful structural tailwinds, specifically the geopolitical drive to decouple supply chains from China, plus the undeniable rising demand for both EV components and nuclear fuel. These support a potentially very strong long-term position. So yes, the risk is high, no doubt about it. But the potential reward, driven by their unique operational moat in strategically vital materials, is deemed significant enough by the sources to warrant that strong bullish rating.
That strategic importance really feels like the ultimate factor here, doesn't it? The trump card, maybe?
I think it is. The Outlook summary we reviewed really highlights that continued regulatory tailwinds and direct government support for both nuclear and rare earth supply chains remain the absolute key drivers here. So just think about this. Given the current geopolitical climate, the intense focus on national security, on energy independence, how truly valuable is it to the U.S. to control its own domestic production of high-purity NdPr and, critically, those heavy REs like dysprosium and terbium? If the market starts valuing this domestic supply chain not just as a commodity business, but as a genuine national security asset, well, how much of a premium is the market ultimately willing to pay for that kind of supply chain autonomy? That's the real X factor here. That's what might accelerate this company way beyond even the current quite bullish financial expectations, potentially overriding some of those short-term commodity price swings. It's something to really consider.